Alright, let's dive right in. We're here for a strategic briefing on what is, without a doubt, one of the
Hit the subscribe now.
biggest shifts happening in corporate finance. My goal today is to cut through all the noise and give you a clear executive-level view on the technology that's about to redefine how money moves. I know that's a pretty pointed question, right? But it's one we have to ask. Think about it. Every other part of your business is running at the speed of the internet. But when it comes to global payments, well, a lot of that is still stuck in the past. It's slow, it's expensive, and it's needlessly complex. And that's the core problem we're going to tackle today. So first up, let's talk about the new speed of money. And the technology at the absolute heart of this whole transformation is something called a stablecoin. Now, you've probably heard all about those super volatile cryptocurrencies. This is not that. The entire purpose of a stablecoin is literally in its name, stability. It's not designed to be some speculative asset. It's designed to be a reliable digital version of a dollar, one that can settle a transaction instantly, 24/7, anywhere on the planet. And this right here makes it crystal clear for any CFO or treasury head. On one side, you've got assets like Bitcoin, which are completely unsuitable for managing a company's treasury because of the wild price swings. But on the other side, you have asset-backed stablecoins which act just like digital cash. It's the difference between a roller coaster and a rail. So the two big players are going to run into in this space are Tether, which goes by USDT, and USD Coin or USDC. Both of them are built with one simple goal: to hold a one-to-one value with the US dollar. They are, for all intents and purposes, the main digital dollars in the ecosystem right now. Okay, so this brings us to a really important point: the huge contrast between the old legacy systems and these new modern ledgers. Let's really look at how the financial rails we use today stack up against the ones being built. And wow, this table just lays it all out, doesn't it? With traditional banking, sending money across borders can take days to actually settle. With stablecoins, we're talking about seconds. The costs drop from, these big percentages and fixed fees down to just fractions of a penny. You go from depending on this long chain of middlemen to having direct, programmable control over your own assets. I mean, it is a fundamental shift. My favorite analogy for this is one we've all lived through. It's the move from postal mail to email. Sending a bank wire is like dropping a letter in the mail. Yeah, it'll get there, but it takes time and a lot of people handle it along the way. Using stablecoins, that's like hitting send on an email. It's instant, it's direct, and it costs basically nothing. So, okay, we get the technology, but here's the crucial question. How does this actually create a real competitive advantage for your business? This isn't just about moving money around a little faster. It's about unlocking brand new strategic plays. Let's start with the most obvious one: the impact on your bottom line. We are talking about a potential reduction of over 99% in cross-border transaction costs. Let's make that real. A $10,000 international wire that might cost you $50 through a bank could cost you less than 50 cents using stablecoins. This isn't just a small efficiency gain, it's a massive change to the cost of doing business globally. But it goes way beyond just cost savings. This is where things get really strategic. You can pay a supplier in a country that has a really unstable local currency, and you can give them the stability of a digital US dollar. Operationally, think about this. Every single transaction is recorded on a permanent ledger, which means reconciliation can be totally automated. Think of the hours that frees up for your finance team. And all of a sudden, you can access markets where traditional banking is just plain unreliable, reaching basically anyone who has a smartphone. Okay, now for what is arguably the most important part of any executive briefing. We need a clear-eyed look at the risks. Because, let's be honest, adopting new technology without a deep, sober understanding of the downsides is just not a smart strategy. And this isn't some theoretical question. If a major stablecoin were to lose its peg to the dollar, it could set off a massive liquidity crisis across the entire digital asset world. We're talking about frozen capital and widespread financial damage. This is the central risk that absolutely demands rigorous due diligence on your part. So let's break these risks down into three critical buckets. First, regulatory uncertainty. Governments all over the world are still figuring out the rules of the road here, and that creates a landscape that's constantly shifting. Second, and this one is crucial, is reserve and liquidity risk. The question you absolutely have to ask is, for every digital dollar out there, is there a real dollar or a highly liquid equivalent sitting in a bank somewhere to back it up? Trust is everything. And third is systemic contagion. Like we just talked about, the failure of one big player could create a domino effect across the whole market. So all this risk doesn't mean we're about to replace the entire financial system overnight. The reality is a lot more nuanced. What we're actually moving toward is a hybrid system, where the best parts of traditional finance and digital finance start to merge together. You know, that simple narrative of disruption is actually a bit misleading. The major financial institutions, they aren't just sitting on the sidelines watching this happen. They are actively exploring, they're investing, and they're building on this technology themselves. They get it. They understand that the fundamental rails of finance are being upgraded for the digital age. And we can see this evolution happening on three main fronts. You have governments exploring their own versions of this, so-called central bank digital currencies. You've got major banks that are already integrating blockchain for their own internal settlements. And then you have this whole new wave of FinTech companies that are building the bridges between the old system and the new. This tech is becoming a permanent fixture of the landscape. So with all of this in mind, the big question is, what now? What are the practical, actionable first steps that your organization can take to prepare for this shift and, more importantly, to capitalize on it? Here's a pretty straightforward 4-step roadmap to get you started. First, just look internally. Assess your current payment flows and identify the biggest pain points. Where are you losing the most time and money? Second, run a small pilot project. Use a blockchain payment gateway for one specific use case to see how it works. Third, get your legal and compliance teams involved now to build a solid framework for how to handle these digital assets. And fourth, find a qualified digital asset custodian to partner with. That's how you ensure the security of your funds. Look, at the end of the day, this change is happening, whether we participate or not. The fundamental infrastructure of how value moves around the globe is being rebuilt for the internet age. The only question left is whether your business is going to be on the right track to take advantage of it.